Thanks, everyone. We got an excellent panel about the economy here. We have some changes. One of the traders dropped off, so we got another trader here. And then
For the invite.
so I'm going to let everyone introduce themselves. My name is Hormoz Faryar from ATFX Connect. I'm based in Dubai. So I'll let you guys introduce yourselves for like 30 seconds each about your company and what you do.
I won't need 30 seconds, I don't think. My name is Sam Horowitz. I am head of liquidity at Finalto. We are a multi-asset, very data-driven broker-dealer. In the spirit of being a guy who looks absolutely terrible in hats, I'm wearing two hats. I also serve as a committee member of the ACI UK.
Excellent. Victor.
Hi, my name is Victor. I used to be the lead editor at Finance Magnates a while back. Then I went into a journey of running my own fund, and I'm going back into the intermediary industry very soon. But I'll
Yeah, you can't reveal that yet, right?
not yet.
Okay. On Monday, he can reveal which broker he's joined.
Hello, my name is Eddie Tofpik. I'm head of technical analysis and senior markets analyst at ADM Investor Services International Limited, which is part of the Archer Daniels Midland Group, which is a huge agricultural behemoth that you've probably heard of or haven't heard of in some cases. I'm also chairman of the UK Society of Technical Analysts, which is the oversight body for UK technical analysts. That's a not-for-profit organization. And I'm also a director of the International Federation of Technical Analysts, which is the United Nations of all the technical analysis societies.
Great. Gonzalo?
Hi, my name is Gonzalo Canete. I'm working for ATFX as a global market analyst. I'm a fanatic of macroeconomics and geopolitics. And yeah, I'm doing every morning an early market report for free. So if you like my interventions and you want to join us, you can just let me know later, and I'm going to give you access to my free newsletter I'm sending every morning, 8 a.m. Thank you.
Yeah, free sounds like it's free, but it's like ATFX pays a lot for that. But people get it for free. Yeah, so my question is, of course, what's on the title, Trade Wars. I just want to quickly, just for everyone to know, what is trade wars? Why is it happening? Why do people do trade wars? It sounds like a silly thing. It's like you know, throwing food at each other or something. You know, what is it? Why do people do it, Sam?
Well, I think that the most important thing to distinguish is real trade wars versus, I think, the American version, which really is throwing food at each other at the moment. And the reason it's important is because timing-wise, you know, real Cold War, trade war style activity is a slow burning thing, right? It takes a while for the full effects of these things to kick in. And therefore, for the sort of audience that we have today and what people really care about, can you trade it? Do you need to factor it in for risk management? No, not really. Let's contrast that with what we have, the insanity that we have at the moment coming out of the US, which is literally mudslinging. Stuff you can put in place one day on a soundbite on 140 characters on Twitter and roll back a week later. Looking at this stuff has become like news trading. It's not real. Anybody with a brain knows that Trump can't implement 95% of the stuff he says he can implement. And it's all transactional diplomacy. So it's all very much leaving aside the hysteria part. It's a transactional way of doing foreign affairs.
Okay, I think Victor is going to disagree with this because you're going to say this is impacting traders, and you've seen this firsthand.
No, look, of course it impacts traders, it impacts brokers. I'm just gonna say that trade wars are a precursor of real wars. So I hope that we don't have to get to the second part of a pattern that has historically been repeating. And mercantilism, which is basically trade wars, is coming back every 70 or 80 years back into the space. And let's just hope that we don't
we won't see real.
This
Eddie, what is a trade war? What's the definition?
Well, it's really interesting because if you ask this question, say, back in the 70s, 80s, or 90s, a trade war would be something where one person is undercut, or one country is undercutting another country, and therefore in whatever product or service they're trying to provide. So you're finding a situation where you have a war between one country and another because they're undercutting them, whether it be steel, whether it be I don't know, cement or concrete or something like that. They were cutting on one another. What we're seeing since the last 10 years or so is a different format where we're seeing tariffs being put on. So prices are actually, a war is being instituted not by one country undercutting another, but by one country adding on top of another on its imports. So it's a different format of war. And I think that's very, very, it's a subtle difference, maybe not so subtle, but it's a difference that needs to be seen. What is exactly a trade war? Because what we meant, say, 20, 30 years ago is not what it means now. And that's a real key point.
Is it less impactful now? Is that what you?
No, I think the impact is now
More
is
wider.
the way I see it at the moment, it's a form of taxation. It's a form of regressive taxation because it hits everybody at the same level. Whether you have a billionaire or millionaire or somebody just doing an average job, the cost of whatever is that's being hit goes up. And some of those are basic foodstuffs. Some of those are basic things that we rely on, but they're the same for everybody. So that's one of the things I think is a regressive form of taxation.
Gonzalo, how do you look at tax, the trade wars definition?
Well, more than a definition of what is a trade war, I will say why we have a trade war. I think the reason why we have a trade war is very obvious. United States is the biggest client in the world. If we take in consideration in numbers what is the global consumption of United States as economy, is the biggest market. I think Donald Trump knew how to see this point and use this point as a leverage to try to recover the lead of U.S. economy in the world using the weakness of U.S. economy, which is the high importation of the economy. So what they do is basically tell to the rest of the world, since now on, you invest in our country or we stop buying your businesses. We can analyze that just to give a reference for the audience. If we measure what is the aggregate demand of US economy and the total consumption of US economy is even bigger than the whole BRICS together. It's bigger than the European Union, almost the double. It's bigger than the Chinese consumption, literally close to aggregate demand of China, but it still is massive compared with the rest of the economies. If you are the main client customer of the world, you can use a trade war to win the battle and force them to invest, which is exactly what we have seen in the last 10 months, right? Companies announce billions of investment in the United States to avoid the tariffs.
Makes sense. I guess the big question for all of us is, if we have a trade war now, which we have, and it's pretty bad, it's been going on for a year and or longer, twice maybe. But so is this gonna be a trigger that maybe starts a crash in this AI bubble, or maybe the rare earth metals, or some kind of stress on the economy that triggers something big just because of what's happening with this trade war? Sam, what's your thoughts on that?
Well, let's talk about the potential AI bubble first. Crash seems the opposite of what can happen because the stable door is the horse is bolted out the stable door now. AI is not going back in the box. Consumption of resources required to power AI globally is only going one way, and in a hurry. Right? And look at the S&P. What's the makeup of the S&P? Top 10 tech firms are like 49% of the S&P or something. So, and the place within that is there is just massive, ongoing, relentless, systemic demand for most technology consumer products, and especially chips and the raw materials to power this stuff. Trade wars are only going to make that. They can only make it more scarce. They're not, as to Eddie's point, it's not an undercutting war anymore. It's a tariff war. So it's only going to make this stuff harder to procure, if anything. Is there a second order effect? Does physical inability to procure those resources cause another kind of crash? Possibly, but in terms of the stocks themselves, I see them only going one way as a result of this.
There's only one way up.
It's like anything. It's like London house prices. They'll stop going up when people don't physically try and move there every year.
Yeah.
I think that the rare earths debate is already obsolete for the AI industry because we're hitting the limits in the energy space, especially in the US. China is way ahead of generating energy. and the bottleneck for the AI industry in the US is now with the turbines and the energy generation. So
Well, that's why Google are building SMRs, right? SMRs are going to be the great white hope of AI, apparently.
oh, that they're definitely much more energy efficient.
I mean, there's a lot to unpack there. First off, I don't think you need a trade war to trigger a bubble in AI. The bubble is going to be triggered, I think, by something we don't necessarily expect, which will be already mentioned, the fact that we need power. You can have as much AI as you want, but you haven't got the power to run it. And that's the main thing. There's, let me give you an example. Utah, square state in the middle of the United States. There, if I remember rightly, Meta are building a huge data center there, which is within 10 miles of where Tesla are going to be building a battery factory. Between those two of them, they're going to employ 4,000 electricians. New jobs, high-skilled jobs, good jobs that'll be there. The problem is that in the whole of Utah, there's only 1,000 electricians. They're going to have to get people in, and that is what's going to slow things down. You're not going to have that power. You're not going to be able to get that in. Now, SMRs, great way. Rolls-Royce, you've seen the big move up in Rolls-Royce, aero engine company, which makes the submarine nuclear engines for the Royal Navy. They've adapted that to run SMRs, I think, on 2 trucks, basically. You can run 4,500 homes on 2 trucks, and that's it. That'd be great, but it's nuclear, and it's a matter of trying to get people to buy into the idea of having nuclear. And that's another thing. So there's a lot of things going on there. There's a lot to unpack in that respect.
Yeah, that AI is complicated. Victor?
I would also add that SMRs have not proven themselves as a technology.
Yeah, they are.
The scale of
They're in the nuclear. The nuclear submarines are running on them for the last 50 years.
But big nuclear power plants are way more efficient than SMRs.
Yeah, but they take up so much carbon, and they're not necessarily
yeah, but
the right
we still don't.
We're losing transmission.
We don't have a company that is delivering them in real life.
At the moment is.
Well,
not to Tesla.
Where are they running? In which state?
The ones, the small reactors they're actually running, are in the submarines. And they've
but
adapted that to go.
That's an isolated space, as you said.
Look, my idea is we take the submarines out and let them run in the backyard. But so
yeah, no, I'm about to agree with Eddie in this point, because one thing is the solution is clear. It's nuclear energy. Even when that's going against the green agenda, especially in Europe, we're closing nuclear reactors in Europe, right? No one's know really why, but that's the policy. We got a British company, Rolls-Royce, working in micro-nuclear reactors for data center. It's still a project, but the truth is certain cities, for example, United States, for instance, in Baltimore, they experience like 50% up on electricity bills at the moment. They say caused by big data centers, massive data centers. The projection of how this issue could go, I guess, is in the numbers again. If we check the data, we check the numbers, we can get an idea. 140 billions investing in infrastructures for AI. That's the projection they have in the United States. If they start to build massive data centers with no solution at the moment on renewable energy, so nuclear reactors, we know that it's going to affect the electricity bill. One interesting comparison, if you allow me to do, is if we compare, for example, the production of energy in the United States, they still got many things to do. China, for instance, is producing more energy than the United States. China is doing, since 2019, massive investment in even gas and oil industry, even overpassing the big players like ExxonMobil and other companies. And even in those cases, it doesn't mean that China got the key for AI, but still the CEO of NVIDIA, for example, says so that recently. But one comparison I was about to say is like Soviet Union, for example, in the 80s was producing more steel than United States economy, and still Soviet Union falls and United States is still there. So it doesn't mean that energy is the key for the AI, but it means that it's going to cause certain troubles for the US economy in the future for sure.
Yeah, we got Lena who arrived and she's demonstrating how bad the infrastructure is in the UK and why she would love to move to Dubai.
Exactly. Apologies, everyone. Lena Komileva, G+ Economics. So I was a victim of UK policy risk on two fronts. One of them was the Jubilee line deciding to collapse on me. And the other one, of course, is the UK budget getting leaked by mistake half an hour early. So if things were not already bad for this government, they really got kind of bad today. Although if you haven't seen the news, the budget has actually been received very well, but it is complete shambles. So Rachel Reeves decided to please the markets and please her party. And in the meantime, she delivered a completely economically illiterate budget that just confirms that we are low productivity, high debt, high tax economy. But that's me getting that off the chest. If I could just join apologies to the panel as well.
Yeah, the question was basically the AI. So can the bubbles burst because of these trade wars?
I heard this really good comments. And I'm very, very privileged to be speaking to this audience and with this panel today. Now, I have to say, as a veteran of the global financial crisis, I've made it my job as a financial economist to always go out and learn about the things that are not in the economics textbooks. So I spent a fair bit of time talking to technology entrepreneurs and investors this year. And I have to say, across the entire range, there isn't a single one that doesn't believe that we are in an AI bubble. Having said that, I think the economics of a bubble are something interesting. And I think that what we have learned in the last month's collapse in US technology stocks and in the market behavior in recent weeks and indeed in recent days is that we're far away from the tipping point. So the AI concerns are really built on the fact that the economics of AI are quite unforgiving, very different from previous technological sort of shifts, mega shifts like cloud computing, for example, because the investment upfront is so high, but the revenue generation in future is really hard to determine, both in terms of scale, but also timeline. But what's clear at this point is that there is still, there is no shortage of demand, there's a shortage of capacity. So we're still in the early build-out stage, and as long as those billions, hundreds of billions are planned for expenditure for the next 2-3 years, then it's hard to see how we're going to see an end to this. The other thing, however, to note is that what we've seen in how the market's behaving through this very orderly deflation of US tech valuations in the past month is that there is no lack of appetite among investors for AI, but what there is a great discernibility. So a bit like the kind of the sages on this panel talking about the nuances of this. And I think that this is still a technology that's still in the early days. You're absolutely right. There's going to be an energy technology revolution off the back of it. And I'm already seeing the next sort of winners of this. And I'm talking about Korea. I'm talking about Spain. Spain has been an amazing market this year. And Spain is very much at the sort of the cutting edge of both green energy revolution, but also, of course, the data centers and that. So at this point, we're still figuring out how to build. You're absolutely right on every single point that was made so far. But just, the common denominator, if I could kind of thread it all together.
We need an argument at this point, don't we?
We have a shortage. Well, we have a shortage of labor. So that labor needs to be imported or trained. We have a shortage of raw materials. So those raw materials will probably have to be mined. And there's a great deal of capacity in the world that still has to develop. Latin America stands out. South Africa stands out. And we are nowhere near the end of that sort of initial curve. The fact that we are talking about AI bubble is probably a healthy thing.
Okay, so wait. Any of you engineers? So I'm the only engineer on this panel. So I'm going to disagree with you guys and say innovating your way out of.
We count data engineering.
No engineer. So innovating yourself to some kind of energy solution is not as easy as it sounds. I think throwing money at an energy issue, I don't think we might solve it within 2 to 3 years and have some amazing technology that will incredibly just create energy for all the AI and everything we need. I don't think we'll have that. That's my opinion. So I disagree. I think we will have a big crash in AI that will clean out a lot of stuff, and then we will have the big thing again. So we will have a big crash in AI, in my opinion, and it will be triggered by not being able to feed it with energy. And those innovations, Rolls-Royce, all this, might take 10 years, 20 years, maybe longer.
I totally agree. And from what we're seeing up until now, is the gas burning turbines that are in the highest demand.
Yeah, or remember the coal plants who were feeding the
coal
Bitcoin.
revival. Yeah.
Yeah, I'm about to say just two couple of examples I bring to the panel. And then we'll let the audience decide if it's a bubble or not, right? But we recently know that Microsoft and NVIDIA was announced 15 billion investment in Anthropic, right? But Anthropic at the same time is renting Azure services, which is Microsoft, and also hiring the cloud microchips from NVIDIA, right? We also got NVIDIA announced plans to invest 100 billions in OpenAI, but the data centers of OpenAI also are hiring NVIDIA microchips. At the same time, OpenAI got investment from Microsoft, from Oracle, from SoftBank. So investors are the same as suppliers and not the same like customers. They are the same altogether.
It's a bit like brokers financing IBs in emerging markets.
Even bank system.
And we're not even talking about Google wading into this and telling Sal Altman, all right, mate, you've had your fun, but let the big boys take it.
Bring this back to the idea of trade wars?
Yes.
We seem to be sort of wandering off, as every panel that we've always been on seems to be going on. The idea of trade wars, where do you think, if there is going to be a trade war, where do you think, if it is already existing, where do you think it's going to be? And I think it comes down to the rare earth metals that we're talking about. And in that, you've got to look at places where they exist. And the big one at the moment, obviously, is Africa. And it's a type of neo-colonialism is going to be happening where we're going to be trying, everyone is going to be trying to get their piece of Africa.
Where in Africa are they mainly? Is there
DRC, I think, if I'm not
DRC.
mistaken. I mean, there are other places in the world. I mean, China is very, very full of those. And I think obviously Russia is as well. But, you know, the obvious place would be to try and see where they could be something there. And so it's who's going to go for that piece, who's going to go for that piece to get their share of it. And that could lead to further hostilities in form of trade.
Okay, so if Victor, last point before I move.
Yeah, since you're an engineer, I'm gonna ask you, since China is right now processing 99% of rare earths, will there be an easy
Anything
way
left?
for the colonizers of Africa to process these minerals actually?
Yeah, it's going to be difficult, yeah.
I'm going to bring something that came up, and I'm trying to remember the conference it was at. It was during London Metal Exchange Week. The head of Trafigura said, it's not where the metals are, it's where the processing is. And that's going to be key. Now, if you're going to do that at Minehead, good luck with you. There's only so much you can do. And there's not going to be electricity there to do that. But you've got to, it's where the processing is. That's where there's going to be key.
We don't know. I don't know. Like, I know you said DRCs, maybe, you know, where is it being processed? China, right?
China.
I mean, most of it goes to China to be processed.
Processing is there. Okay. So here's another question I have. Let's say we're going to have these trade wars escalate. So we're going to have a lot more Trump, another 2.5 years or longer, maybe 5-10 years. But Trump in there, more trade wars, escalation. How would you, as an investor or company, how would you trade that? Can you, Sam, would you buy gold, or what would you buy? Bitcoin? That's an energy tie to Bitcoin there, maybe?
Bitcoin's an energy play, I guess. I mean, Bitcoin's interesting because Bitcoin's now transformed completely from pure speculative punt trade with no easy due diligence on what you're doing, and you're almost guaranteed to be trading against the informed flow in the market. But now you have, you know, systemic buying for ETFs. So now you have some systemic underlying demand at the whole time. We're not quite there in stability, though, because we've still seen a massive shakeout in the last month. So you can't yet trade Bitcoin as a store of value against the trade war, I think. But fast forward 10 years, I would suspect that that is what will happen.
How about gold?
Gold still, I mean, gold demonstrably. Look at the price action this year in precious metals, right?
So it proves that trade wars Buy gold.
Buy gold with diamonds.
Well, it worked with both Trump terms. I mean, if you remember 5 years ago when he was during his first term, gold was one of the best performing assets after he became president. So it's happening all over again. Nothing new on this front. Where would I be investing money? I have no idea.
I mean, I think the obvious answer obviously has been gold, and that's been shown to be true. To a certain degree, silver as well now. And I was casting my mind back. I don't think any of you were in the market. You weren't in the markets in 87, were you?
Not far off, but no.
No, right. No, you weren't either.
I was walking under a table.
Yeah, well, I was on the markets in 87, and that's the biggest crash I've ever seen in my life. And, you know, forget about 08 or 09, that was serious,
The
but
Black Monday, is it?
87 was horrendous.
Black Friday?
And it comes down to what happened then, and I think will happen again if you have a crash, which is that people go towards consumer staples, things that actually you need. So, you know, it's Maslow's pyramid of needs. You know, it's first off, you need shelter. So it's basic things to do with shelter, basic things to do with food. Those equities and companies will survive and will carry on. They may not be the same now as they were before or after this crash, or what they were back in 87. But you've got to look at something like that as a protection, but also gold. And I think that's fair. And then, you know, you can still look at, say, some of the government treasuries. They still work as being a store of value. Whatever you may think, the dollar's been horrendous this year. And as a technical analyst, I'm saying this now. And I also give my stuff for free. Oh, nice. But there is a potential for a key reversal up in the euro and a key reversal up in sterling, an annual one, which means for a long term, those currencies will be heading stronger. And this is a multi-year thing.
Euro and pound.
Euro and pound. There are other things, but I haven't got those ones I remember.
The dollar's going to weaken even more.
Even more. But this is over a longer multi-year basis. But they need to close at certain levels. I've got them written down in my wallet, but I'm not going to bring them out now. But if you want me, just contact me and I'll let you know what the levels are. But it's those things will be key, will be, you know, good quality fixed income, the gold, possibly silver, and then staples, consumer staples, things that people need. They will be your protection.
But you also have to look at, if you're going to consider, you know, trading as a risk management art form, do you get the return on the risk you're taking in individual instruments? Like G10 Volt, there are no bargains.
It's not about return. It's about protection, capital protection.
But you're going to have to pay price for it. So is the price the correct price?
The price will go up for those things, and you'll have to pay. I mean, look at gold. You know, when I started in gold, it was trading around about $350 an ounce. Now it's, you know, at a zero and a little bit more on top of it, and you're over 4,000. So the whole thing behind it is things. You know, yes, you're going to pay. You're going to have to pay. We're paying the price now for what happened, I think, with Ukraine. You know, we had a huge move up in food prices and energy prices. And then we've had the big move down. And now we're paying the price for that big spike up. And now we're paying the market coming back down again.
Gonzalo?
Well, I will say I will bet for U.S. economy, U.S. equity in particular. I will say everything related with commodity. I think we are drifting from a world order based on a financial control to a new real assets and change supply and control. And it's something clear based on, we're talking about trade war based on United States sanctions, but it's also true that the rest of the players, global players, are using indirectly sanctions as well, because China is also restricting the access to rare earth to other countries. And we know that is a key point to develop technology. Without those materials, you cannot develop technology. So I will say that's why I believe the future right now is on those real assets and commodity. And I agree with Eddie with fixed income as well. And on the top of that, there's many reasons we could explain this. Like, for example, for instance, what Eddie was mentioning right now, Ukrainian war. I can tell you where definitely I will not invest, and it's in Europe. I believe euro as a currency could face a collapse in the coming months or years. I truly believe in that, basically because if we take a look what is going on in Germany and France, politically, economically, they both in trouble, in different reasons, but in trouble, both of the main economies, France and Germany, which is the two pillars of the euro. On the top of that, I believe the Ukrainian war was a trap for US economy, for European economy. I believe in that because on the top of everything, we got Russia, for instance, last year. Regardless of the sanctions, they apply to United States applying to Russia, forcing Europe to apply those sanctions, forcing Europe to destroy the energy market and business they got with Russia, which it was a Nord Stream 2. Still, last year, United States was buying 50% of palladium from Russia, 40% of fertilizer for agriculture sector from Russia, 20% of uranium for nuclear reactors, commercial nuclear reactors from Russia. So the sanctions against Russia are to be applied by Europe as a tool, or I would say as a, like a kind of
Suicide.
So exactly, they use European Union sacrifice to keep the US economy running, and that's why I believe the only chance we have if we look for equity markets is in United States, because it's the biggest market and it's going to keep going in that way. Donald Trump did well this year, managing massive investments. At least so far, we have seen compromise, even from European Union, to invest 600 billions in United States economy.
I didn't realize US was buying so many things from Russia under all these sanctions.
Well, and also people, Russia is selling to other people as well. Like India import, like, was it 25% of their oil from Russia? China's imports from Russian oil have gone. China were doing it before the war. India was a direct result of the war. It spiked immediately.
Don't forget Dubai and Russia.
Even IMF was rectifying certain numbers last year, 2024. One of those numbers, it was the growth rate of Russia. So it's interesting to see that after all of these 2-3 years of sanctions against Russia, the GDP of Russia last year, it was fixed by IMF, increasing by 4%, 4.5%, while German GDP is crashing for the third year.
Can I just say something very quickly? The other thing about Europe, I mean, today, Belgium is on strike. The whole of Belgium, general strike. I've been there once when there was a general strike. It was horrible. So they're on strike. So there are a lot of things. France, yes, I understand. But France has always been in a situation like that. Germany, it's sclerotic in its own way. I don't necessarily think that it's the whole of Europe, because you've got other countries in Europe which are growing. For the first time ever, Poland is now a G20 country. Poland. It was a basket case 30 years ago. It was part of the Eastern Bloc, but now it's grown to such a degree that it's actually entered the G20.
So this is very interesting. Unfortunately, I have to invest money. I invest a rather chunky portfolio, so I do have to actually put my money where my mouth is. When it comes to the US, I fear that the US economy has become highly dependent on AI investment. And so I am very much aware of the risk that geopolitical friction has been more or less priced out of US equities. So if we are to move into a new regime where Taiwan comes into play in 2026, then the rare earth issue will be a small problem to have, a storm in a teacup, compared to the real issue of chips, getting chips into the US economy. So I fear that any geopolitical policy shock could knock this economy off. On the other hand, the markets have now kind of shown signs of a turnaround, and that's not surprisingly coinciding with expectations that the Federal Reserve will probably shift towards cutting interest rates. If it's not in December, it's going to be in January. It doesn't really matter when a marginal 25 basis point cut will arrive. But for us to get some tailwind for that, we probably need some repricing. In other words, a conviction that the Fed will keep going after that, and that means a weaker U.S. consumer. So between the fragility of AI investment dependency and the rather precarious position of the U.S. consumer, arguably the most powerful consumer in the world, at a time when only a third of US tariffs have been passed on, and another 2/3 will probably have to work their way through into consumer prices in the coming months. It's tricky to see how that. So I actually like Europe. for the simple fact that Europe is way cheaper. I also like parts of the world, particularly parts in Asia, because I think that the AIA theme is not going to go away. And we now have more attractive valuations on some measures than we've had since the April-March episode of this year. Now, the trade wars are not going to disappear, but we're not in a kind of a global policy shock that can paralyze investment into a global recession scenario, which is where we were back in those days. So I do think that there are good places to stop. Now, when it comes to Bitcoin, very quickly, what we have seen is that Bitcoin, although I think structurally the demand for that is coming from a understandable desire from a great many countries, the BRICS being of course, of the unwilling holders of dollars. I mean, there's a real strategic push towards moving away from a dollar-based international system for the very fact that the US is so good at applying sanctions, weaponizing its financial hegemony on its perceived enemy of the day. Now, having said that, we have seen that Bitcoin is rather dependent on US liquidity conditions. It collapsed first before the technology stocks sold off in this latest leg. And this is at a time when, and it's down 30% from the peak, at a time when, even the worst case scenario, US technology, when you look below the G7, we're looking at what, 20%, 10% decline. So it's pretty heavy. But so it's not necessarily a great store of value, but I think that structurally there's a baseline from which the Bitcoin cycle will continue to grow in the years ahead. As for gold, we did see the speculative rush into gold. This is the extraordinary thing. The gold was meant to be the great diversifier, and it was, up until a time when it became a geopolitical risk play. So leverage is, I think, the greatest risk in the global financial space at the moment, and that leverage can go on a dime compared to, depending on the momentum rolls of the day or winds of the day, which could shift depending on where a very transactional US president wakes up, or where a very strategically sort of adversarial Chinese party feels its interests are.
I think you made quite a big assumption in saying that you like Europe as well, and that is the elephant in the room is the assumption is Russia are done with invading other countries, and there is no more proliferation. And the polls don't sound like they're as confident. And a lot will probably hang on whether this, the Baltic states harrying the shadow fleet now, whether that actually works. I don't see the big powers rushing to their aid on this, and
So
they don't want to.
Why Poland is, to Eddie's point, the reason why Poland has become such an exciting place is because what Europe's realized, its growth model of export dependency and of supply chains on which it has no control, whether it's Russia or China, is no longer sustainable. And that is driving the biggest investment push for a generation. And of course, Eastern Europe, Czech Republic, Poland, places like that, Bulgaria even, are already playing out as the key sort of places. When I say peripheral Europe, I really do include Portugal and Spain. I think Portugal and Spain are very interesting in terms of that shift towards technology services. They're emerging as they're great places to invest.
So we're running out of time, but we might have time for a question from the audience. But before that, I'm going to briefly ask you guys, do you think this trade war during Trump's 2.5 years, 3 years left, can lead to more wars, real wars, than trade wars? Yes or no, essentially. Can Trump's, presidency lead to real wars now as we go into the last 2.5 years of his?
I think, to Eddie's point earlier, I think systemic shortages of things that we really need, and we can go down Maslow's hierarchy of needs, can historically has triggered wars. Doesn't have to be tariff related. Does Trump have 2.5 years left on his presidency? I'm not so sure about.
You think it's more?
No, I don't know.
There's rumors that he wants to go for another term.
Can a convicted sex trafficker be president? I'm not sure. So
I
I suspect there will be at least one more systemic major shock during Trump's presidency, like a proper market event.
One.
And that systemic shock might be closely related to Trump's effort to dismantle the Federal Reserve.
Wow, that would be big. Okay.
And it's coming next year.
Okay.
You don't need a trade war to start a shooting war. You don't need that. You can do it with something else. But the only thing I'd point out is a risk point, which is in approximately just under a year, which is that this truce with China was put out for a year. It runs out in October next year. 1 month or a few weeks before the midterm elections, which will decide how Congress looks. So I think that was a very clever move by the Chinese to run that to that period, because it will run out just ahead of when they can renegotiate again with maybe a different Congress.
Well, I will say there is a clear interest to keep the wars going. Even this morning, I included in our daily report one of those comments. Like we have seen the last two days, mainly the negotiations between Ukraine and Russia, promoted by Donald Trump. And I would say the only ones who are argue about that peace agreement is European Union, because he's not part of the table. He's not sitting there. He's not negotiating with that. And we have to face the fact, the truth. War is business. And if Europe is not invited to those business, after all the money they have sent there, they are not going to let them sign any peace agreement without be participating in a mineral exploitation in Ukraine. Even France mentioned, we were dealing with Ukraine about mineral exploitation before you mentioned even any peace agreement. Donald Trump obviously wants to keep them clear. One thing I want to share with the audience, something we observed the last year, right? It was negotiations between Ukraine and Russia initially promoted by Donald Trump months ago. 24 hours before the meeting with officials from Russia and Ukraine, it was an attack, a massive attack from Ukraine on Russia, a successful attack, really good one. 43 planes from military bases in Russia were destroyed, right? 24 hours before they sit together to discuss any peace agreement. Obviously, I think there was a clear interest to blow up that meeting. In the case of Iran, when Donald Trump was trying to negotiate a new nuclear agreement with Iran, right? Again, 48 hours before that meeting, Israel attacked and killed part of the engineers who were members of the table negotiating that. We have seen also the case of Qatar, when they were negotiating, US delegation was negotiating with a terrorist group of Hamas. Israel invade Qatar airspace and attack Hamas delegation, which means clearly, I believe Donald Trump trying to get the picture has a Nobel Prize of peace, right? And he openly say, like, I'm the one who is promoting the peace and end the world in this world, right?
But does Zelensky even need to negotiate at this point? He could just sit there. He's demonstrably winning the war.
Zelensky is just
And he's winning, he's not losing it.
well, he's
But
winning.
if he's trading drones for helicopters now, which is what I'm reading, then he's winning the war in terms of chess piece
I think
substitutions, right?
The only answer will come from citizens in Ukraine if you ask them, because they pick it up then in the streets and send them to the front line. So I think that's the only. And obviously in Ukraine, the elections are cancelled because they are in a trade war process. So Zelensky is still there in an extra time, but still we call them democracy and we keep running. Yeah. And I will also say on the top of that, the whole growth rate of Europe depends on that 800 billions they put in defense industry. So it's the only chance Europe got to keep running the industries, the war. If there is a business agreement between Russia and Ukraine promoted by United States with new business between United States and Ukraine,
in trouble. Okay.
Europe doesn't have anything to do there.
As long as Horowitz, you tell us what you think about the outlook at the end of this. But I'm aware we're over time, and it's been a very active debate. So, look, this is how sort of the world looks at the moment. We started the year on a very different sort of note from where we're ending, and the reasons for that are three. The first and the foremost is excess Fed liquidity. I cannot emphasize this enough. It is the fact that the Fed continues to lubricate the global markets machine, the fact that despite rate hikes, we had extremely easy global financial conditions has been the key driver momentum here. The second thing has been the fact that AI investment. It was a structural shift, completely independent from the geopolitics, completely independent from consumer balance sheets, and it's here to stay. And the third one is the fact that China managed to wrestle from President Trump sort of the baton in terms of driving the trade war narrative. And that's kind of happened with that rare earth conversation. So as long as those three remain in place, we're here. But I cannot emphasize, I really don't have enough time, unfortunately, to tell you why economic projections are not worth the paper they're written on. What we have seen this year is that things can change based on political economy motivations, and the reaction is non-linear. Things can change very rapidly, and then the direction goes into a very different sort of destination very, very quickly, quicker than we can hedge. So I think that this is a time to go and position yourself into the more defensive sectors, which means better valuation, but also greater insulation. Great insulations from the headwinds that are clearly play. When it comes to Europe, I mean, whatever happens, whatever the next headline is on Ukraine, the European eastern border will remain unstable. That is already in the price. That is really it. What is not in the price is the fact that the AI boom is still in the early stages. Yes, there are going to be ebbs and flows. Yes, there are going to be ups and downs. But we still have a capacity constraint problem globally, and that capacity constraint is going to roll out into other parts of the world. So look away from the US. The US is a very structurally volatile and fragile story, and move towards part of the world that can really leverage on that.
Amazing. Thank you so much, everyone. We've run out of time, I'm afraid. So that's it. Thank you.